Good evening, traders. Today is Monday, February 13th. Markets have been closed. You guys know what happened today. It was one heck of a squeeze. We're going to get into that a little bit later, but we're going to get into the next order of the day that everyone wants to know about, is CPI tomorrow. I'm going to kind of give you my thoughts. First of all, I suspect it's going to rip to the upside tomorrow. I'm going to show you some things about the Fed balance sheet and Powell admitting to disinflation, and we're going to quickly discuss the new CPI weightings. You know how they've recalculated it, that it's in the news. Oh, it seems like it's going to be hot. It's going to be hot. I don't think it's going to matter, honestly. I don't think. You'll see it in a minute here. Okay. And we're also going to get into a little bit of what futures is doing tonight. Futures / extended hours. You might open your eyes a little bit. Okay, I think they're priming something, and I don't think it's to the downside. Okay, and then we're going to get into intraday tweets. All right, so the first order of business. Take note of this gray dashed line. You're going to see me reference it again. You're going to hear me reference it again in the tweets. It goes to SPY 413. Okay, so gray dashed line goes to SPY 413. That's right there. Okay, but I also want you guys to note this pink line. This pink line is a downtrend resistance line that also intersects at this juncture of SPY 413 and the gray dashed line. Okay, so it's like, yeah, it intentionally targeted this spot today because these are juncture points now, key juncture points. Okay, key. Okay, so also note it was basically consolidating underneath of there in the afternoon. That's bullish. Okay, anytime you're consolidating, and you did not get a major rejection. We got a rejection earlier today, but it wasn't major. It didn't like send it way down. It just kind of dipped it. Okay, I was like, all right, I see what's going on here. All right, so that's what I want to show you about that. So let's just get into. Okay, uh, these are actually two different YouTube videos right here. Let me turn on my pointer here. Okay, so this one you can't really read it. Is the disinflation has started. Okay, Powell admits to it. He admits that disinflation has started. Okay, and Powell is also acknowledging that they are passively shrinking the 8.4 trillion from the balance sheet. Okay, so I've previously discussed in my previous YouTube episodes that there was 8.5 trillion. Okay, fine, it's 8.4 trillion now. Okay, still out there in the economy, right? 8.5 trillion still out there in the economy, and he's admitting to it, right? Passively shrinking, meaning just letting it roll off as they come, the mortgage-backed securities and bonds as they come due. Let's just let it roll off. They don't buy anymore, right? They don't buy anymore up to a cap. Once that cap is reached, then they will keep buying. So they're actually still buying. Okay, but the outflows is greater than the inflows that they're buying. Okay, now 8.5 trillion passive reduction is the same thing as disinflation. You're going to see that in the next slide. I'm going to prove it to you. Disinflation is the same as CPI reduction. Okay, they're all related. Therefore, the 8.5 trillion balance sheet is it will cause disinflation that Powell has admitted to, and disinflation will cause CPI to go down. Okay, so Paul Volcker, the whole Paul Volcker narrative, in my opinion, is fabricated. Paul Volcker didn't have 8.5 trillion in 1979, guys. You can't compare this era to the Paul Volcker era because the technical underpinnings and the economic underpinnings are not the same at all. You see what I mean? It's the $8.5 trillion balance sheet that has caused the disinflation. Has caused inflation, CPI to go up. And this is the evidence of this. I've done this in previous episodes, but I'm just going ahead and show it to you now so I won't make you go back and watch any of my previous episodes. Okay, This red line is CPI. Okay? This is the Fed balance sheet. Okay? When I draw a regression of this blue line, this is a regression line right through the Fed balance sheet data. Doesn't that look eerily parallel to the CPI? Yeah, I think so. Okay? And then what happened from 2020 in when COVID came, pandemic? Boom, huge spike in the balance sheet to the tune of 5 trillion to be exact, okay? 5 trillion dollars. Huge spike. And what do you know? That resulted in a huge spike of the CPI, okay? Therefore, what I'm saying is in this tweet, there is no correlation between the federal funds rate, roughly 5%, and CPI. None at all. The correlation of CPI is to the Fed balance sheet. In other words, the Fed's balance sheet that really kicked off since the 2008 global financial crisis, the GFC, right here. See that? This is 1 trillion right here. This is 1 trillion. That started in 2003. Guess what? That was the end of the dot-com burst. 2003. That was the low. But then all of a sudden, starting in 2003, they injected $1 trillion and held that for 5 years. Yeah, 03 to 08. They had $1 trillion in the economy. And then, lo, what happened? Boom, 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 boom. Okay? The Fed has, since 2003, the last 20 years, is the sole cause of inflation, hands down. It has nothing to do with the federal funds rate of 5%. Okay? So, the markets know that. Right? The markets know it. Okay? So, that's why CPI, and you'll see that in the next slide also, the new way they're calculating it. But if you look at this, basically what we're talking about is the Fed will never admit it publicly, obviously, but they know they caused this inflation since 2003. For the last 20 years, they are the sole cause of this inflation. Okay? So what we're actually doing right now is calling on the very arsonist who caused the fire to put out the fire. The whole federal funds rate at 5% thing, that's just all red herring. That has nothing to do with CPI. All they have to do is reduce the balance sheet, and CPI will come down. Okay? So the whole federal funds rate thing, it just has to do with, well, it makes it harder for businesses to take risks because the interest rates are way, way, way higher than they were even 2 years ago. Remember during 2020 when it was closer to zero. Okay, so that's all they're doing now. They're just preventing companies from taking on more risky projects. So it slows things down. They're not hiring as much because they don't have newer projects to go off and go do. Okay, that's really what the federal funds rate is designed to impact. Okay, so Nick Timrose, Wall Street Journal, you guys have heard of him in the news. Okay, just focus on this. Here's the new weighting in the dark blue and the old weights in the light blue. The new weighting is still going down, but it is relatively higher than the old weighting. That's what the news media is trying to pump. Oh, see, the new CPI is going to come out hotter relative to the old weighting, but it doesn't matter because look, even okay, right here, Nick even admits to it, showing somewhat less deceleration than before. That deceleration is disinflation. Somewhat less than before doesn't matter because it still has disinflation, right? See what I mean? CPI is still coming down, but just coming down at a slower rate according to the new weights. But the markets already know, based on this graph over here that you can't see anymore, the markets already know, yeah, it's going to come down. You just got to kick up your balance sheet reductions, and that will in turn kick up the rate of fall of the CPI. See what I'm saying? So this whole new weighting thing, that's just all whatever. I think ultimately tomorrow markets don't care. I think they're gonna rip higher. And here's why I say that. Tonight in extended hours right here. Tonight. Wake up. Wake up. Why would you do all that? only to crash it the next day, the following morning. I don't think so. Okay? I don't think so. Now, here's SPY futures on the left. I drew in that gray line that I referenced earlier, SPY 413. Here it is right here. You're consolidating under this line. And you guys heard me say, anytime you consolidate under a major line like this is the old gray channel that was in play in November and December of 2022. You're consolidating under that. That's bullish. Okay, so you combine this consolidation along with these big wicks up, big wick up. I don't think they're doing this to crash it tomorrow morning. That just doesn't make sense. Okay, so that's my 2 cents on CPI. All right, so let's go ahead and get into the intraday tweets. First one up to bat, back testing now. I'm using these opportunities to buy the dip. Okay, you guys who have followed me, you guys know I always say wait for the back test. In other words, wait for it to come up above the EMA 50, back test down to it, and then go up again. That's what the back test means. In this case, I'm not waiting. I'm just buying the dip. Because I had already seen enough in pre-market data and whatever. The best analogy I gave on Twitter today was, look, I don't need to see the train coming on the tracks. I don't need to see the train on the tracks to know that a train's coming, because I can already hear it coming. Okay? In other words, if I see the trains on the tracks, that would be equivalent to seeing the back test be successful. In this case, I just, as soon as this started going down, I was buying. Buying on the dip. It's like, I'm not waiting for a back test. Okay? So, okay, this is an important point. Remember, when you're at major channel bottoms, like that red dashed line that we took overnight in overnight pre-market futures, we overtook it. On Friday, it was resistance, but today, this morning, it was support. Okay, when you are at major channel bottoms like 408 it's now a channel bottom, you get fierce reactions like this. Boom, boom. Okay, that's an important point. All right. Okay, see how it's wicking up? Oh, right here. We're skipping a little bit. We're now at the 4-hour SMA gray line. You could tell it's going to be a successful backtest because look at the wick up, wick up, wick up. Buying pressure. That's buying pressure. She's not going down. Okay, that would have been right here, equivalent to right here. All right. Okay, when we finally got to, what was it? Yeah, right around, yeah, right up here. Yeah, right up here. Right in this area. Yeah, I'm scaling out of calls. Well, when it hits 413, see? 413. 413, yeah, right here. Well, here, right here. See that? 413, right there. There's the gray line. That's what I'm talking about. The gray line intersects right with 413, okay? So, yeah. So there was just a nice cluster. When you get into this nice cluster of very important zones, like the channel gray line and the blue line, 1213 wick high, those are important. Those are considered like targets, right? Intraday targets. Like, where do you think it's going? It's always going to an important junction point, okay? That's how 413 was determined, all right? Okay. Oh yeah, at this point, I was just noting that they're starting to show a slight negative cross on the MACD, but there's no bearish divergence yet. But it was a slight negative cross, and that would have been, yeah, right here, right there, yeah, right there, equivalent up here. So just kind of start. You gotta pay attention to that. But it's also going to back test to the SMA 20 gray line right here. That would have been equivalent to right here. So, okay. And I already said down here, I've been scaling out a little bit already. I'm like, yeah, I'm happy with this move up because, the distance between here and ultimately up here, when you don't even include the chop. See, we were in some chop for a little while, right? What was it? 411.50 compared to 412.50 or so. See, so it's, one basis point, right? Okay, so, um, yeah, I even said I may even scale out at 412.50. Close enough. I didn't really want to get up to 413 and then get out. No, I don't want to do that. Okay, so, uh, yeah. By the way, I said I thought that the SMA 20 was going to pass the back test right here. That would have been right here. And yep, it did. Yep. So, but I also said I am not going to scalp this small leg up to 413, meaning from here to here, I am not scalping that. No way. That is too close now to resistance. Nope, I'm not gonna get calls. uh-uh. No. Okay. So, yep, scale out of calls, guys. As Johnny K correctly notes, there's bearish divergence. I'm already out. Yeah, yeah, we started seeing bearish divergences now. It's like, okay, prices is going higher, MACD and RSI is going lower. Okay. So, um, one other thing I'll note is you just it's your call when you want to get out. As soon as you start to see bearish, I'm pretty quick. Once I start to really see it, I'm out. I don't. I mean, technically, you could have waited. See, all this time, you could have waited a while. But when does the sinkhole drop out on you? See, you don't know. Now you're on borrowed time. The longer you wait for that bearish divergence, the longer you wait, now you're on borrowed time. Okay? So, oh yeah, bearish divergence is clear. Market maker is slowly floating this to 413. Yeah, that's what he did. Slowly, slowly, slowly. Right? Then the hammer comes down on unwitting traders. Because what happened once it got up to it got up to 412.97, I believe. Yeah, 412.97. Yep, right there. That's it. You got up to 412.97, and then boom, down, 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 down. See what I mean? It's like, at what point do you want to ride the edge? So it's up to you. It's up to your risk tolerance level. Okay. So that is basically all that I've got today. Relatively short. Please follow me on Twitter where I give real-time tweets like I did today, calling out the game as I see it. Don't forget to listen to your favorite music as you are trading. It helps you get into your flow state, helps you get into your zen. Please give this video a like, share, subscribe, or click to be notified when I release something new. With that, I'm Agent 00 signing off.